Good morning. This is Bloomberg Daybreak Europe. I'm Joanna Bersecci in Dubai, and these are the stories that set your agenda. Investors raise bets on the Fed cutting rates as Donald Trump gets an early chance to name a new Fed governor in the coming days. Asian stocks pair losses and U.S. futures advance. Firing the messenger. The U.S. president removes the head of the Bureau of Labor Statistics after data showed the weakest U.S. employment growth since the pandemic. And oil declines as OPEC Plus approves another bumper output hike, reversing supply cutbacks a full year ahead of schedule. Well, good morning for everyone who's joining us. Let's take a look at how some of these markets are faring. Quite a dramatic day on Friday with that triple whammy of weaker jobs growth, President Trump firing the head of the BLS, and that Fed Governor Adriana Kugler saying that she's stepping down from her position. So all of that happened on Friday. You had a major pullback in Wall Street with the majors, the S&P down 1.6% on Friday, the Nasdaq down 2.2% on Friday. European markets also ending almost 3% lower. But this morning, look, it is a sea of green. Everything is turning around, not fully paring back the losses on Friday, but does tell you that sentiment has stabilized, and perhaps because the market has moved to price in faster and quicker rate cutting cycle out of the Feds, with another 25 basis points worth of rate cut priced in for this year. Flipping over, let's just take a look at the handover from Asia, because over there you did get a bit of a mixed bag. The broader index is flat, but if you look at the Nikkei, for example, trading a lot weaker overnight, the handover there pretty negative as their investors start thinking about rate hikes coming through from the Bank of Japan and the impact that could have on corporates. 10-year yields also in focus. Massive move on Friday, lower 14 basis points for 10-year yields. I spoke about front-end pricing. September rate cut is now 90% priced in. Another 25 basis points worth of rate cuts also priced in for 2025. So the theme was one of fixed income strength on Friday after those jobs numbers came through. The USD slipping a little bit today, down about 7 basis points. And then Brent in focus after the OPEC Plus decision of the weekend to put back that additional 547,000 barrels per day to the market. It's been taken well, but attention now moving forward to what the demand picture is going to look like in Q4, especially with this backdrop of weak U.S. growth and those tariffs that were announced last week as well. But let's go back to the top story from Friday. Donald Trump's decision to fire the chief labor statistician has been described as damaging by her predecessor. Erika McEntarfer was fired from the Bureau of Labor Statistics on Friday after weak jobs data for July and sharp downward revisions for May and June. Kevin Hassett, the director of the National Economic Council, said it was time for new blood at the BLS.
The bottom line is that there were people involved in creating these numbers. And what we need is a fresh set of eyes over at the BLS. And there are great career staffers. One of the top BLS staffers is actually working in the White House to help us understand the jobs numbers. When I saw the jobs revisions, I literally called up that person and said, I think there's a typo. Because I've been following these numbers all the way back when I worked with Alan Greenspan for something like 40 years, and I've never seen revisions like this.
Let's bring Bloomberg's value title. Earlier on, I was talking about this triple whammy to markets on Friday. With the first, you get the weak jobs numbers and the huge downward revisions. Then you get the firing of the BLS chief. And then you get the announcement that the Fed governor is stepping down. Walk us through the market reaction, Val. It's been a lot to take on.
Giovanna, it was a payrolls Friday to remember, that's for sure. But let's start on the payrolls data itself, because as you heard from NEC Director Kevin Hassett there, they were quite substantial revisions downward to previous months. And if we look at past data, it's actually one of the most substantial revisions outside of a recession in decades, Giovanna. So a lot of questions on just why the first round of this data wasn't too clear. Remember, this is a data set that not only the Federal Reserve relies on for its policy, but this is one of the most renowned sets of data. You know, the unemployment rate, the payroll additions to the U.S. economy is really the best macro indicator we have for global economic growth. With these revisions taken into account, the 3-month run rate now sits around 35,000 jobs added per month, which is the weakest payroll addition that we've seen since the pandemic, going all the way back to 2020. And the curious thing about this is that this came just days after we had the Fed Chair Jerome Jerome Powell characterized the labor market as solid nearly 13 times in his press briefings. This is really about face for the market to deal with. We saw the two-year yields, the very policy-sensitive front-end yields, drop by 28 basis points in the session on Friday, Jumana, the biggest drop that they've seen since 2023. So going back well over a year. The S&P 500 also had the worst session since May. And then with this BLS chief fired, it does pose questions over who will retain that seat and will there be possibly some political influence into the world's biggest labor market bureau.
Yeah, Goldman Sachs putting out a note this morning saying that the downward revisions were the largest revisions that have happened since the 1960s, just to give some context for those numbers. But as we spoke about, the president, Donald Trump, is also set to name a new Federal Reserve governor after Adriana Kugler announced her resignation on Friday.
You know, I have a couple of people in mind. I'll be announcing somebody for the filling of the person that left. A woman left, as you know, who is I guess a Biden appointment, either Biden or Obama, but I think a Biden appointment. And she left early, and I think she left because she agreed with me on interest rates, and yet they were on the other side of the ballpark, right? So I'll be announcing that probably over the next couple of days.
So, Val, the president's got a choice now. I guess the expectation from the market is he's going to try to put in someone more dovish, or at least a dovish governor on in that seat. But what does that mean for the eventual chair replacement once Fed Jerome Powell steps down? Is there sort of some potential cannibalization that could go on here?
No, that's very right, Jumana. There is potential for the market almost to watch this new Fed pick to the governor's board to replace Adriana Kugler, even more than the markets watch Jerome Powell, the shadow Fed chair kind of idea. But this is very important for the market, especially when it comes to timing, Jumana. Will this new Fed governor be seated by mid-September when the Fed convenes again for their next policy decision? Could they possibly be someone who could dissent against Powell's decision to hold rates steady if that's what he decides to do? So a lot of questions out there, but Adriana Kugler handing in her resignation. Again, very funny question on timing. Why did she choose Friday? Was it because after this big payroll miss? And remember, this comes after the Fed meeting, which saw two governors dissenting, the most dissents that we've seen since going all the way back to the 90s. So the question about timing on what spurred her resignation is definitely being chatted about in the markets. But remember, Adriana Kugler's seat, she was due to step down from that seat when it ended in January. So this is giving Trump a few months head start to having some political influence, having some dovish influence on the Federal Reserve Board. Now, it's all questions of timing on whether maybe the Senate can push through a recess appointment over the month of August in order to get this new governor seated by the mid-September Fed decision.
Yeah. Oh, one thing, though, Waller and Bowman, we spoke about it at the Fed last week, and they cited some of the weakness in the labor market, perhaps feeling a bit vindicated right now. Bloomberg's Valerie Teitel, thank you so much for the recap. Now, let's switch over and talk about energy markets. Oil slightly lower today after OPEC Plus agreed to another major output increase, stoking concerns about global oversupply as countries wrestle with the impact of the U.S. import tariffs. Joining us for more on this is our Middle East energy markets reporter, Anthony DePaula, on set with me. Anthony, I guess not a major surprise that they went ahead with this last clip, 547,000. What is the justification from OPEC's standpoint, or the Group of Eight standpoint, to bring this extra barrel back to the market?
Yeah, good morning, Jumana. Well, obviously, the deliberations around this, I mean, that's something that you covered as well with your recent trip to Vienna, talking to people there about what are some of the factors in there. As you say, not much of a surprise that it happened because markets were expecting, and some of the reporting from Bloomberg going into that meeting was expecting that they were going to keep that additional big-sized cut going into September and really unwinding this round of voluntary cuts. What is kind of the surprise, though, and has been throughout, is how well the oil market has been holding up.
Yeah.
And some of the motivations that OPEC Plus was talking about was the fact that the stockpiles were low. So that's one signal that they watch that shows weakness in the market. If oil is building up in storage, stockpiles have been low, and there's been a lot of product demand, a lot of transport fuels, gasoline, diesel, and that's really helped the refinery margins. That has helped support the price and the demand going forward.
Have they lucked out a bit on timing because of geopolitics as well? You had the impact from the Iran-Israel war. So at some point, there was a lot of geopolitical premium priced in that came back again. But now there's this floating threat of potential secondary tariffs, secondary sanctions on Russia if the Russian president doesn't meet that August 8 deadline on ceasefire discussions with Ukraine. How much do you think that is getting factored into where the price of oil is trading right now?
Yeah, geopolitics has been kind of a wild card for the oil market over the last couple of years. And the oil market has generally seen right through that. And what I mean by that is they're looking at supply. Supply hasn't been interrupted. So as long as supply hasn't been interrupted, we don't see these big spikes in oil prices. And now, of course, there is some geopolitical premium, some additional price on the oil market there. So that's kind of balancing out this influx of new supply, which would normally bring the price down, is being balanced out by a little bit of this geopolitical premium that's keeping those prices kind of in that stable range. We've seen some discussion from some of the analysts that they don't think the OPEC plus countries are going to really go into the market and bring more production on if Russia is sanctioned, because Russia is a member of the OPEC plus. But of course, this kind of pre-positioning does bring some more oil into the market ahead of that time. So we are probably in a good place going into the autumn, where we're expecting demand to decline.
But for as long as you and I have been having these conversations the last couple of months, so many analysts in this space have talked about a mismatch between supply and demand, or anticipation of that happening in Q4, beginning of Q1 next year. With these latest tariff announcements, what is the likely impact going to be on demand, or is that already factored into the price?
We're still waiting to see what the impact is going to be on trade. So far, trade has been maintained. We're waiting to see also in the U.S., they're talking about inflation, waiting to see whether that's going to come through in inflation. So really, this is looking like kind of a lagging response. And until we kind of see that response in there, if it hits trade, how much that is going to affect demand, we're going to see that come in probably a little bit later. And that could be a potentially problematic time, because, as I said, demand is looking to decrease after this kind of summer boom of travel, driving, jet fuel. So we may see those two things come into the market together, and that may be the challenge.
Yeah, but bottom line is they managed to put back 2.2 million barrels per day and a much faster time horizon than anyone thought was possible, with oil still trading around $70. Bloomberg's Anthony DePaula, thank you so much for the recap of OPEC. Now, Canada's minister in charge of U.S. trade says Prime Minister Mark Carney and U.S. President Trump are expected to talk over the next few days. This after the two governments failed to reach a deal before the August 1st tariff deadline.
The conversations have been informative, constructive, and cordial. I would expect the Prime Minister will have a conversation with the President over the next number of days. That's certainly my plan, again, with Secretary Lutnick, recognizing that we think there is an option of striking a deal that will bring down some of these tariffs.
For more, let's bring in Bloomberg East Asia government editor John Herskovitz. So that August the 1st deadline passed, but there's still been a continuation with the discussions taking place between the U.S. and Canada. What is the likelihood in reality for them to reach some sort of a revised trade deal that would bring down that 35% floated tariff rate?
Oh, sure. The Canadian Trade Minister LeBlanc said that he is optimistic. And the fact that there are talks going on at the highest level between Prime Minister Carney and President Trump, this brings some promise. But there's also a huge amount of uncertainty. We've seen the back and forth between Canada and the U.S. going on for months. And if there is a change, what is the framework that's going to make these changes? We have the U.S.-Mexico-Canada agreement, which may provide some outline for this, but it's difficult to see how this is going to be resolved and the mechanism for it. And also, Prime Minister Carney's in a bit of a bind. He was able to come to office with the promise that he would take a tough line with Trump. At the same time, he's got an economy that he has to protect. So where things play out is difficult to say, but the talks are coming up. This does pave a path where there could be a resolution, but getting to that resolution could be problematic.
Yeah, it's never a linear path. Meanwhile, U.S. Trade Representative Jamieson Greer sounded a cautiously optimistic note on discussions with China on rare earth flows.
They really focused on rare earth magnets and minerals. China has put a global control on the world. And so for the United States, we're focused on making sure that the flow of magnets from China to the United States and the adjacent supply chain can flow as freely as it did before the control. And I'd say we're about halfway there.
John, we've spoken about this before. In the case of China, it's not just about tariffs, but also about export controls as well. How do these rare earth magnets fit into the current discussions that are taking place between the U.S. and China?
Sure. I mean, the fact that these magnets are, the negotiations of them are kind of a symbol of progress and a litmus test for where things are going to go. The magnets, the control of the rare earth magnets, which are used in production from things from appliances to missiles, these were part of China's retaliation in April when the tit-for-tat movements were going on. China has increased its exports in June from May, but they're still at levels before the friction really heated up. So for China, this is one of the big cards that it has, the rare earth magnets and rare earths in general. And we're also facing another deadline. I believe that this ceasefire or this trade truce is coming to an end next week. So progress on one hand with the magnets, and this could bode well going forward with the talks. But these are the world's two biggest economies, and the stakes are enormous.
Yeah, I believe that other deadline, there's so many deadlines to stay on top of, but the U.S.-China one is August 12, and the U.S.-Russia one is August 8. So there you go. It's all up here. Bloomberg's East Asia government editor, John Herskovitz, thank you so much. All right, coming up, Indian Prime Minister Narendra Modi strikes a defiant tone in the face of President Trump's threats of sanctions against buyers of Russian oil. We'll have the latest next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Indian Prime Minister Narendra Modi has struck a defiant tone in the face of President Trump's 25% tariff rate. He's urging citizens to buy locally made goods while New Delhi continues to buy Russian oil. For more, we're now joined by Bloomberg's Ruchi Bhatia in New Delhi. So, Ruchi, tell us more about Modi's Buy India message. Is it a message of defiance?
Oh, absolutely right. This is, in a way, a message of defiance. The U.S. president last week saying that it is good if India has stopped buying oil from Russia. But on the other hand, we did hear the Indian officials making it very clear that the relationship between New Delhi and Moscow remains time-tested. It is not a relationship that has been built over the last few years, but the last few decades. India and Russia have had very stable relations. And this dates the Cold War era, and the relations now have moved from just being strategic relations to the economic sphere as well, where India is buying more oil and weapons from Russia. Having said that, the Indian officials also making it clear that no such instructions have been given to state-run refiners and private refiners to not buy oil from Russia. This is coming in at a time when Prime Minister Narendra Modi over the weekend urged Indians to buy more goods locally, and that would help shield the Indian economy from the wrath of U.S. President Donald Trump's tariffs.
Yeah, we were just showing numbers there suggesting that the U.S. is still India's largest trading partner. And yet we found out last week that the U.S. are applying one of the highest tariff rates, at least in the Southeast Asia region, 25% on India. What kind of pressure is the country facing right now?
There is definitely a lot of pressure because remember, India was one of the first few countries that it did seem like that U.S. will get into a deal with, but looks like India now faces tariffs which are far more higher than some of the Asian manufacturing rivals and also India's neighbors. So definitely the pressure is immense, and this is coming in at a time when the Indian economy is also facing a slowdown of sorts. India is not growing at the kind of 8% average levels that we saw in the last few years. Growth this year could likely be between 6 to 6.5%, and that, of course, is the big worry. But remember, India's economy is mostly domestically reliant. It is not reliant on a lot on exports, and which is why Prime Minister Narendra Modi's call now is coming in at a time where he's urging Indians to buy more locally, and that would prop up the Indian economy.
Bloomberg's Ruchi Bhatia, thank you so much for the overview there. And coming in, we check in on China's dominance in clean tech manufacturing and whether it will hold in the face of U.S. and EU protectionism. That's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. China's stranglehold on the equipment needed for the energy transition has become a flashpoint in trade spats with the U.S. and Europe, and it's easy to see why. China has more than 70% of capacity across nearly every stage of clean technology manufacturing, from solar modules to batteries and wind. BloombergNEF's Stephanie Muro joins us now. So, Stephanie, how have China's exports of clean tech grown, quite simply, in the last few years?
Yeah, well, thank you so much. What you were just saying, that Chinese clean tech manufacturing is quite important because it is not only catering to its domestic market, but it's also going to other countries. And what we have seen at BNEF in clean tech, in the trade and supply chains team, is that China has been leading the exports of 8 of the 13 components that we're tracking. And if we look at the chart right now, we can see that in 2024, lithium-ion batteries and electric vehicles are some of the sectors where exports are skyrocketing. Actually, if we consider, it's more than $80 billion. And comparing to many other, to all the other years, we can see that it's quite impressive.
So where are most of these exports going? Well, what is driving this massive shift upwards in exports?
Yeah, well, initially what we have seen throughout the years is that most of these exports were going to developed countries, and more specifically to the US and the EU. However, there have been some factors right now that has been shifting these flows to emerging markets. And as we can see in the chart as well, is that most of these sectors, especially electric vehicles exports, have grown 25% towards emerging markets. And one of the most importantly factors for this is prices and cost. Since right now, like, most of the prices have been very decreased, China can now serve to emerging markets where, importantly, upfront costs are most importantly for them.
So interesting. Stephanie, thank you so much for joining us. Stephanie Muro from BloombergNEF. Well, later on, we're going to be talking more about the energy markets and the price action in oil today. We're seeing a little bit of a dip after that OPEC Plus decision. We'll be joined by Amrita from Energy Aspects to digest the weekend's oil output decision by OPEC Plus to bring back 547,000 barrels per day of extra production back to the market as of September. That rounds up their 2.2 million barrel per day voluntary cut introduced in 2023. So stay with us for that discussion. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Jumana Versace in Dubai, and these are the stories that set your agenda. Investors raise bets on the Fed cutting rates as Donald Trump gets an early chance to name a new Fed governor in the coming days. Asian stocks pair losses and U.S. futures advance. Firing the messenger. The U.S. president removes the head of the Bureau of Labor Statistics after data showed the weakest U.S. employment growth since the pandemic. And oil declines as OPEC Plus approves another bumper output hike, reversing supply cutbacks a full year ahead of schedule. And let's take a look at how some of these markets are faring, because we are seeing stabilization despite all of the news that hit on Friday with that weak jobs growth number, with the downward revisions, with the firing of the BLS chief and the stepping down of Adriana Kugler, one of the Fed governors. Despite that, what we are seeing is a sea of green for futures. European markets seen opening up 0.5% higher, FTSE 100 a similar amounts, and S&P and NASDAQ also seen opening up in the green. Despite the pullback that we had on Friday, both of those majors closing down between 1.5% and 2%, so ending the week on a negative tone. But switching over, the handover from Asia at one point was a lot more negative, but by the end of the session, some of those losses had been paired as well. The Asian Pacific index, you can see, is slightly positive on the session, up 0.1%, though we did see a big drawdown in the Nikkei. It was down 1.4% there as investors start thinking about a faster hiking cycle out of the Bank of Japan in coming months. 10-year yields in the U.S., big mover on Friday after those jobs numbers came through. We'd moved down about 14 basis points over the course of the day. 2-year yields down about 25 basis points. So very strong reaction there as investors were quick to price in a faster rate cutting cycle out of the Feds, with September now about 90% priced in for a Fed rate cut. The USD also slipping a little bit today, down 7 basis points as well, so slightly weaker versus other majors. And then Brent also down just fractionally this morning, just 16, 17 basis points. Brent sitting just shy of $70 here, despite the fact that OPEC Plus did go for that last clip, putting back 547,000 barrels per day as of September. And you have some of those tariff and global demand concerns heading into Q4. We'll talk more about that in a moment. So Brent continues to move a little bit lower after OPEC Plus agreed to this major output increase, with the progressive restoration of supplies over recent months widely seen as a concerted push by the group to reclaim market share. For more on this, I'm joined by Amrita, founder and director of market intelligence at Energy Aspects. Amrita, you and I were speaking in front of the OPEC seminar about a month ago in anticipation of this last clip, and obviously they went ahead and did it. There's been minimal market impact this morning. I mean, we're down about 0.2%. It's not that much to speak of. Do you think that this perhaps sets the stage for OPEC Plus to start thinking about the other voluntary cuts, the 1.6 million barrels per day, the other tranche that could also begin to get put back to the market as well in the coming months?
Hey, good morning. No, I think it's too early to talk about that, right? They've just finished unwinding the 2.5. And I do think the communique made it very, very clear that all options now remain on the table. They can pause after this, which I do think is very likely. They want to take stock of the market, see where fundamentals are. They could even reverse the 2.2 that they've just unwound. I thought that was the most interesting thing that was published, right? At the end of the day, what they're trying to do, and one of the sources was saying to me, is that this isn't just a gambling decision. This has been thought through in terms of the market actually requires it. This is OPEC Plus being proactive, preemptive, but also being precautionary. And at the end of the day, what they are trying to do is effectively navigate what is a pretty complex market, right? If you think about it, at the start of the year, everyone came in bearish, and yet what we've seen is a market that continues to be stronger and stronger because inventories are not building.
Yeah. The other big event that has happened in the last few days is we got some clarity on what these global tariff rates are going to look like. How is that likely to play out? What impact is that going to have on oil demand, you think, in coming quarters?
I think the challenge with the tariff situation is that it continues to remain a headwind for oil demand, and our demand number is only 800,000 barrels per day of growth. That reflects that. But I think the problem, or rather the way I would put this, is that has already been priced in, right? The market's expecting that. Nobody's bullish demand right now, right? So it really is about supply. And I think that's why what OPEC Plus is doing, and particularly against a backdrop of potential sanctions and the other tariffs, right, which is secondary tariffs, should President Trump impose it for buyers of Russian oil. I think that becomes the bigger driver of balances and sentiment going forward.
If Trump does go down the route of imposing those secondary tariffs on Russia, what sort of an impact do we get on the price of oil? How much are we talking?
I do think we're going to go up a fair bit, but of course it depends on compliance, right? It's already very evident that Indian state-owned refiners, and we've got OilX data, we can actually backtrack and see how much each refinery is buying. 600,000 to 700,000 barrels per day, that's what the state-owned refiners buy, already been backed out. That's why over the last couple of weeks, you've really seen a flurry of activity, them buying more West African crude, more Murban, more WTI, and we think there's another 300,000 to 400,000 more that the private ones can back out, even if they kept their long-term contracts. That's a chunky amount. That's India going below 1 million barrels per day. Question is, will China listen? Not our base case, but again, depends on the wider trade talks, right? And again, this is why I think OPEC is being cautious. The 4 Ps I just mentioned, them being precautionary, proactive, preemptive, and preventive. I think that's kind of their mantra to try and balance this.
Yeah, interesting. Let me ask you a supply question, since we've talked about demand. Again, one of the market views right now is we are going to start seeing a slowdown in U.S. shale production. What does the non-OPEC, non-U.S. shale production outlook look like?
It's a great question because, like you said, shale is slowing. And I do think when President Trump talks about U.S. being able to make up for any lost Russian volumes, that's not likely. Simply because, you just have more gas and more oil cut these days. But outside of the U.S., we do have very strong growth this year. Brazil, Guyana, Canada, even Chinese oil production is growing pretty steadily. That was expected this year and next year. But, for me, what is interesting is, again, what is priced in. I think from 2027, the market starts to look more interesting because you don't have that much OPEC spare capacity left after this unwind. And you and I talked about it. Not everybody's even able to increase this production. Russia is a case in point. And then after this wave of big non-OPEC supply projects, there really isn't anything.
Yeah. Amrita, let me ask you perhaps a more long-term question. One template emerged out of these trade deals, which is the countries are not only agreeing to certain tariff rates with the U.S., but also agreeing to buy extra energy from the United States as well. How much do you think that's going to actually move the needle, not necessarily on oil production, but on LNG and in gas in years to come?
I was just going to say it's going to be a much bigger impact on gas than it's going to be for oil. Because this is really about both sides, right? The U.S.'s ability to increase more oil and gas, and that's definitely more in the gas camp. Oil's not really rising regardless, even at these prices, it's struggling. And also the other side is that this is about Europe and some other countries trying to continue to diversify away from Russia. So it is a win-win from both sides, right? The only thing I would say, a lot of the deals that have been talked about wouldn't take the numbers at face value. Some of the numbers, particularly, say, the European ones, there's just not enough volume of U.S. LNG even available in the coming years to fill the numbers that the Europeans have allegedly talked about, right? So I think those numbers, big numbers, get thrown around when Trump is involved, but I wouldn't take them at face value. But the fundamental point is that, yes, we are going to see more U.S. LNG hit the market.
Amrita Sen, really good to talk to you as ever, founder and director of market intelligence at Energy Aspect. So the recap of everything that went down with OPEC Plus and what to watch out for in the coming months. Well, senior U.S. officials visited war-ravaged Gaza on Friday on a mission the White House said was about inspecting food distribution sites and developing a plan to ensure more aid gets in. U.S. Special Envoy Steve Witkoff also attended an impromptu protest in Tel Aviv after Hamas released a video of a 24-year-old Israeli hostage who looked emaciated and extremely thin in those pictures. For more, let's get out to Jerusalem and speak to Bloomberg's Dan Williams. So, Dan, just talk to us about Steve Witkoff's trip to Gaza. He visited the Gaza Humanitarian Foundation, GHF, which is a controversial foundation. What came out of this visit?
judged from his fairly limited public statements, it would appear that he, representing President Trump, was reassured that this is a well-meaning, albeit limited operation so far to feed Gazans. It's worth remembering that this came against a backdrop of surging international concern and condemnation, given images of starving Gazans, especially children. Those images were disputed. The veracity was disputed by Israel, to a degree by the United States. But there's no doubt that Israel's decision 4 months ago to stop UN-distributed aid coming into Gaza, and then weeks into that stoppage, replace it with this GHF, caused major disruptions in the supply within Gaza of food and other aid. And it would appear that the allies, Israel, the United States, are trying to put this behind them, both by surging the influx of aid now and possibly by expanding the operations of the GHF. The question is, once that is done to their satisfaction, what does this bode for the rest of the war? Would they then press the war against Hamas, having, to their minds, removed the international scrutiny of the aid issue, or would they do a more general rethink of whether this war needs to be wrapped up, perhaps unilaterally, by Israel?
Yeah, those are the questions, no doubt, that Israeli leadership will be asking. Bloomberg's Dan Williams in Jerusalem, thank you so much. Well, coming up, BMW goes all in on its electric vehicle offerings, but can it compete with China? That story is the subject of today's Big Take next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. BMW is going all in on its new electric vehicle offering, with the company's future riding on it. The German carmaker's flagship factory set to produce nothing but EVs by 2027. The CEO, Oliver Zipse, has been speaking exclusively to Bloomberg's Tom McKenzie about the launch, its business in China, and how the investment will shape the future of the company as his tenure comes to an end.
Well, we're not waiting for the Neue Klasse, which hits the market in China in the second half of 26. So shortly after we launch it here in Europe. We're not waiting until that car is launched over there, because a lot of capabilities, especially on the digital side, you will already see currently in the cars. So we will see fairly stable volumes, maybe a little bit less than last year, but China is already stabilizing for us. And then, of course, that will give an additional growth momentum in China when this car launches the car. So we will be fairly stable this year, and by the end of next year we will see some growth there. We're very sure, especially because this is also a symbol of the renewal of BMW, a completely new user experience, which is quite unique also in China, you know.
In China, the competition is intense, particularly when it comes to the software and it comes to the technology. You have companies like Xiaomi coming out with the SU7, priced at about $40,000. Some have described it as a Ferrari at $40,000. What gives you the confidence you can compete in China?
Past, current, and future competencies we have. When you look how strong BMW is as a brand, and what you mentioned, the turn down in the industry, this was also partially intended by us, because we were retracting from markets which were not profitable, simply as that. And as everyone knows, there are market segments where you cannot be profitable, and we ask ourselves, growth itself does not have a value in itself. If it's not profitable, we retract. And what we see in the marketplace is various things. High technological advance, and we will give that answer with that car, that we're absolutely competitive in every market, including China. But we are not staying in a market which is not profitable for us. And how that will develop, how prices will develop this year and next year, this has to be seen. You know, and we already see this year stabilizing prices, and that this is partially an extremely unhealthy competition, that everyone knows that.
And you have not been involved in that price-cutting competition in China. BMW has not been part of that, but you have been supporting your dealership network. Does that support continue?
You're always part of a market, but we have not been continuous specific market segments where it was not profitable. At the same time, we're reconsolidating our dealer network. That's happening at the same time to what is happening in the market. And by the second half of this year, we will be through with that. We have less dealers, we have more larger dealers, we have more profitable dealers, we have more experienced dealers. So that is happening at the same time. Why is that necessary? We have been growing by leaps and bounds in China for the last 15 years. And I think maybe it's even a good thing to take a break and consolidate our business, and that is what's happening right now.
Does that consolidation mean reduced workforce, reduced headcount in China, like some of your competitors, some other automakers have cut headcount? Is that something you're doing or planning to do in China?
We also do that. If you have less market volume, of course you adapt to that. The main thing is you have less but larger dealers, which means more profitable dealers, more efficiency.
Well, that's your usual Daybreak anchor, Tom McKenzie, speaking to the CEO of BMW. Well, we're bracing for the market open in Switzerland today, the first session after U.S. President Donald Trump's shock announcement of a 39% export tariff on the country, one of the highest in the world. And, of course, the Swiss index was closed for the national holiday on Friday. Let's go to Bloomberg Switzerland Bureau Chief Jan-Henrik Forster. What are we expecting on the Swiss market open today? Already, the index trading at a deep discount versus other European indices.
The honest answer is I don't know. I presume there will be a harsh reaction initially, and then probably trading will somewhat recover throughout the day. This is long-term stuff. GDP won't contract immediately. Companies have ways to kind of defend their margins, but over time there will be an impact. Question one is, how is the Swiss government now going to react? Are they still negotiating until Friday? And can they find a compromise with the US administration? One. And secondly, is the Swiss National Bank going to do anything? That's my initial assessment. On the market reaction, let's see, I guess, harsh in the beginning, and then it will kind of smooth out.
I mean, over the weekend, I saw that a lot of the press was quite critical of the president and how this sort of all came to pass. Is the feeling in Switzerland now that this very high tariff is somewhat of a negotiation ploy that is put through by the United States, but that it won't actually end up at that rate?
Well, every Swiss person read The Art of the Deal. So I guess the Trump playbook is you start with a very high demand, then you keep pushing, and the compromise is basically you can tell people that's what I wanted to achieve originally. The sentiment is that the U.S. administration won't budge much from here. So the tariff rate is 39%, and probably it's going to stay there. I guess the Swiss. I mean, look, Switzerland is an export country. It doesn't account much to the U.S. To U.S. imports. So I think one thing they could, for instance, do is they tweak their trade balance. For instance, the biggest item is gold as an export item. It's only refined here in Switzerland, coming from London, to make it kind of ready for the U.S. market, to the U.S. norms. So that is something they could just cancel out of the trade balance, and that would probably do the trick. Let's see.
Yeah, what about the conversation on pharmaceuticals, given how big a portion they also constitute of the Swiss index? No clarity there, but of course, President Trump did send a letter to some of the biggest pharmas last week pushing for lower drug prices.
The bigger problem for pharmaceutical companies is the decrease in drug pricing in the US. For now, the understanding is that Roche, Novartis are exempted from tariffs. But we don't really know that. There's a bit of different interpretations about this. Nevertheless, I think market reaction will be negative today just for the sentiment. I mentioned drug prices. So also on this one, let's see.
Yeah. Okay. Well, one of my takeaways is that the Swiss like to read. If everyone's read Art of the Deal, I feel like I need to actually pick up the book as well. Bloomberg Switzerland Bureau Chief Jan-Henrik Forster, thank you so much for the preview. Well, plenty more coming up. This is Bloomberg.
It looks like a healthy labor market that's still well in balance, but with some, disappointing signs that we should watch very carefully. I feel confident with the decision that we made earlier this week. We have to look at the whole picture of the data. When I step back and look at where we are, I see a labor market that is largely in balance.
Cleveland Fed President Beth Hammack speaking to Bloomberg on Friday. But let me just show you one of the charts that caught my attention. Remember, we've been talking about the tariffs and the overall composite number. Bloomberg Economics estimate that the final effective tariff on the U.S. will end up around 16%. But worth noting that about a third of U.S. imports have actually been exempted. So the way these were crafted were actually to exclude certain sectors of the economy. So worth bearing that in mind. Switching over also, just to draw on the price action that we had in markets last week, we did see a big bounce in volatility and also in the VIX. So take a look. The VIX is back above 20, so that's above the 5-year average. Obviously way below where we got to around Liberation Day back in April, but does speak to perhaps a little bit of volatility coming back into the market. The big pullback that we had for S&P and NASDAQ on Friday. Some questions around the impact of tariffs and also what the Fed's plans are. And maybe also some questions about institutional governance with the fact that President Trump decided to remove the head of the BLS after those weak jobs numbers. And then finally, let's just take a look at the Stock 600 as well and what we've been seeing there. It's the middle of earnings season. We will get that in a second. As of now, it is, yes, so here we are. Oh, okay, no charts. As Stock 600, we will talk more about the earnings season as it progresses. But bottom line is what we're getting in the U.S. is an outperformance, upward surprise on earnings, similar in Europe, albeit by a smaller amount. And Bloomberg Terminal users can access these charts and others used throughout the show at GTV Go or on the Bloomberg Terminal. And that was it for Daybreak Europe. The opening trade is coming up next. This is Bloomberg.